Hello and welcome to Between the Lines, the podcast that brings you deep insights into the evolving reinsurance landscape across Asia Pacific. I'm Mithun Varkey, Editor-in-Chief, and we are recording here in the Hong Kong newsroom of InsuranceAsia News. This edition features Trent Brown, CEO of Australian broker Knightcorp. Brown talks about the next phase of insurance broking business and how technology will play a big role. While brokers globally are optimized for placement, Brown says broking is about advocacy, and a differentiated experience is actually what the customer wants. It's a discussion well worth your time.
What clients typically have a problem with is the process. And that expectation is changing. They want clarity, they want speed, they want insights. So as an industry, and what we feel that needs to happen is we need to move from being reactive to being more proactive, from product placement to more strategic risk-based thinking, and from sort of annual engagement to more ongoing engagement. That's a basic expectation the clients are starting to have. And it's going to be the people that build the systems from the ground up that enable that for me are going to be able to compete into the future.
Joining this episode is the InsuranceAsia News editorial team, Deputy Editor Andrew Mullen, Senior Correspondent Aidan Gregory, reporter Roshan Nambiar, and making her debut is our intern, Aleyna Wang.
Hey, Mithun, glad to be here.
Obviously, the biggest development in the recent days has been the US and Iran agreeing to a deal, bringing an end to the war. Andrew, can you bring us up to speed on the latest developments and its impact on the wider insurance world?
Yeah, crucially, that deal includes the reopening of the crucial Strait of Hormuz. Various reports and shipping data we're already seeing suggests that ships have started to cross the strait, but highlighting the volatility of the region, Iran said the strait was temporarily closed on Saturday in response to Israeli strikes on Lebanon. For now, insurers and underwriters are taking what one said is a wait-and-see approach, as it is too early to say if the situation is going to return to normal. Interestingly, this week, Lloyd's launched a new consortium designed to provide additional marine war risk insurance capacity for vessels and cargo transiting the strait. Chubb will serve as the lead underwriter, supported by participating Lloyd syndicates and specialist market partners. The new Marine War Risk Consortium will issue primary policies for vessels and cargo. It'll provide up to $200 million of capacity, separately for hull and P&I risks, with an additional $200 million of dedicated cargo capacity. It's interesting to note that Chubb was the lead underwriter on the US policy announced by Donald Trump that was actually a non-starter in the end because the promised naval ships were busy doing other things. But so Chubb is back involved. That can only be positive given the amount of cargo and ships that are stuck in that part of the world, and it's a crucial part for global shipping. And interestingly, on this topic, there was an email dropped in our inbox just before we started recording. Aidan, you picked that one up. How does that give us the latest on the situation?
So while the peace deal obviously is very welcome news for the global economy and countries here in Asia Pacific, the disruption arising from this crisis is still likely to last many months. And indeed, according to a report this week from Allianz Commercial, there's over $125 billion in vessel and cargo value that's awaiting passage out of the Persian Gulf. And many of these ships and their crews have been stuck there since the conflict kicked off in February. Allianz Commercial has said that the conflict has ushered in a new era of volatility for the global shipping industry.
Thanks, Andrew. And Aidan, indeed, I think it's good news that the strait is open, but it's a fairly narrow strait. All that blocked cargo passing through that strait will be a whole other task and whole other set of risks for insurers. Moving on, we've had some exclusives in the last couple of weeks. Aidan, you had big news about a new broker coming into the Asian market. Can you tell us more about it?
Yes, we had more news from the spiciest corner of the Asian insurance broking market, which is transaction liability. We reported that HWF Partners, which is a specialist London M&A insurance broker, is looking to enter Asia Pacific, and they've been looking around for a local leader to lead their operations in the region. HWF Partners themselves, they confirmed that they are tentatively exploring the region, but the plans are understood to still be at a relatively early stage.
Certainly interesting. After we reported the exit by BMS, we have a new specialist broker looking to enter the market. So it's still a very vibrant market, I would say. Another exclusive we had was more on the people move front. We reported exclusively that Liberty's Hong Kong and Singapore distribution chief, Jackie Chan, has left the insurer. We don't know yet where he's headed. It's a big move in the market. He's a well-known name in the insurance market, and this possibly connected to the ongoing transition that's happening at Liberty. They have a new CEO in Hong Kong and a new CEO in Singapore, and they've united their businesses. So it's quite an interesting development in the Hong Kong market. Moving on from our exclusives, the other big news was from Australia. The ACCC, the Australian Competition Commission, has approved the Zurich-Beazley deal, which we discussed in the last podcast. Aidan, you're across that story. Can you tell us more?
Yeah, as you say, Mithun, Australia will not oppose Zurich's $11 billion takeover of Beazley following a phase 1 investigation under Australia's mandatory merger control regime. And the ACCC said last week that the combination poses an unlikely threat to competition within Australia's specialty insurance market. So it's good news for Zurich, and it's one regulatory approval secured.
Indeed. Following on the earthquake in the Philippines, where there's more information on the earthquake and the claims. Roshan, you've been speaking to loss adjusters in the market. What are they telling you?
Yeah, so the earthquake that struck south of General Santos City in Mindanao on June 8th has now resulted in over 70 dead and has affected over 1 million people. The initial government estimates put losses at around $250,000, but the adjusters that I reached out to said that the figure is probably going to rise as more detailed inspections continue. One of the people that gave me a response was Crawford's Graham Tolentino, who said that it was still way too early to put definitive figures on insured and uninsured losses, but he also warned that the event could be more costly than the Cebu earthquake that hit in 2025. The general response seems to be that claims are already emerging from hotels, schools, restaurants, shopping malls, and even damaged infrastructure in and around General Santos City. Charles Taylor and its Philippines partners seen on Insurance Adjusters say that the final bill is likely to escalate over several months as more hidden structural damage, foundation movement, and even business interruption becomes more clear. The market impact may be limited by low insurance penetration, but reinsurers are expected to absorb a share of the insured losses, which AM Best also mentioned in an article about the quake that it will test local claims management and reinsurance safeguards, even though insured losses should remain well below the broader economic damage.
Thanks, Roshan. Quite a lot of damage across the board. We'll be watching that development. The other big story we had in the recent days was about the surety market in India. Aidan, you wrote that story. Can you tell us what's exciting about the surety market?
There's a lot of excitement in India about the growth and potential of the country's nascent surety market, which is primed for rapid growth over the coming years after the Indian government liberalized the regulations governing surety in India. The driver of the growth is due to India's booming demand for infrastructure financing. There's obviously an enormous pipeline of infrastructure projects that are in the works in India over the next 10 years, which needs to be funded one way or another. And the surety is seen as an alternative source of capital efficient financing to bank guarantees.
I mean, this surety's been talked about for a while now, but it hasn't really taken off in the way that the expectations were. Are there any specific challenges to that market in India?
The challenges that are holding back the development of the market somewhat mainly concern data disclosure and credit quality, and also the treatment of surety contracts by India's bankruptcy code, which isn't necessarily treated in the same way that bank guarantees are, for example, in terms of the ability of lenders to enforce these contracts in the event of a default.
Great, thanks, Aidan. I had a very interesting conversation a couple of weeks ago with Andrew Mullen of Markel International, and Su Cheng was the CEO for Asia Pacific, Markel. I think this is the first interview that Su Cheng has given since he took over as CEO of the Lloyd's player about a year ago. Markel's been very active in the Asia Pacific market, and they've been growing aggressively, opening new offices, entering new lines of business. So it's a really interesting conversation on what their plans are and how they see the APAC market and the opportunities here. So I think primarily, clearly, Asia Pacific is a really big part of their plan. Markel International's expansion plan, as Andrew Mullen put it, they're very skewed towards the London market as of now, and they want to sort of rebalance their portfolio where only about 50% of the business comes from the London business and the rest coming from their international markets. And Asia Pacific will be a key driver in that sector. Obviously, they've expanded, they've added new lines, they've added new offices in the last 1 year. And so they expect that to sort of drive their ambitions in the region. I'd spoken to Andrew Mullen of early last year, and then Markel had a very ambitious top line target. But I think in light of the softer market, they're taking a more selective approach to growth. And I think, as Andrew put it, premium is an aspiration, profit is a target. So the top line aspirations are tempered by the realities of a soft market. But still, they remain very bullish on the Asian market. It's certainly an interesting conversation, an interesting story to read. Thanks, everyone. Obviously, a bunch of really interesting stories. But the Strait of Hormuz situation is far from over. It's still developing. We've seen some volatility around it, as Andrew mentioned. We'll be following that situation very closely and expect more stories from us on this. Let's talk about the stories that we're working on in the coming days. I'll start with Aidan. Aidan, what's keeping you busy in the coming days?
We're approaching the end of the first half now, and I'm looking into how the year has been so far for insurance M&A in Asia Pacific, and what the outlook is for the rest of the year. It's obviously been quite a volatile first half for deal makers, but nevertheless, the M&A market's actually been reasonably buoyant despite all of the geopolitical volatility that we've been living through. So I've been speaking to deal makers and getting their takes on where they expect to see more M&A in the second half of the year, and their perspectives on how the year's gone so far.
Yeah, Aidan, certainly it's been in 6 months. We've seen some really, really interesting deals both in the carrier space and broking space. So we'll certainly be looking forward to that story.
Yeah, indeed. I mean, there have been some pretty banner insurance M&A deals globally so far in 2026. We obviously have had Zurich's takeover of Beazley, and then there's the ongoing situation with Steadfast in Australia as well.
Aleyna, what have you been working on in the past few days?
I'm working on our 1/7 renewal story, and I've now got responses from 4 market players. One is Aon, Loxton, Score, and Horden Re about Australia-New Zealand programs. Horden Re has put numbers on it. They're talking about 10 to 15% cuts on those 3 business, with some insurers even seeing deeper cuts, while Loxton highlights structural shift with active MGAs and raising automated underwriting tools, intensifying the competition. Overall, they see a clearly buyer-friendly market, plenty of capacity, softer pricing, and terms largely stable.
Thank you, Aleyna. I'll be looking forward to that story. Roshan, what are you working on?
So El Nino is a big topic going around in the market right now, and there's even stories about 40 people dying in France. So I've thought maybe I should reach out to multiple people across the industry. I've reached out to some reinsurers, some brokers, some insurers, risk modelers, and even others as well, just to see what they're speaking about in terms of how they're adapting their risk assumptions as climate volatility accelerates.
Right. I think we'll be hearing a lot about El Nino in the coming days. I mean, there's going to be impact to not just agriculture, industrial sectors as well, logistics, disruption, port visibility, apparently. Haze, people are talking about that as well. And there's also accumulation risk for insurers and corporates. Will certainly be interesting to see what the impact of El Nino is. Great. Thank you, everyone. It's been a fantastic conversation. Let's get back to work. I'm joined today by Trent Brown, the CEO of Knightcorp, an Australian independent broker. Brown joined the Australian broking startup as CEO in 2022, having spent many years in the fintech sector across Asia Pacific. Brown brings an outsider's perspective into broking and delves into how the industry is evolving and how technology is playing a big part in the next phase of the sector's growth. Brown says the future of broking is more than just placement. Listen in. Trent, welcome to Between the Lines. Thank you for joining us. To start off, could you tell us a little bit about Knightcorp, how the big company began, what its core value propositions are? What does Knightcorp represent?
Knightcorp was started by Wade Knight. He spent a little bit of time working in insurance. He started at the tender age of 23. I always say Wade did everything wrong and got everything right. So you're not meant to jump in and start your own brokerage when you're 23, when you haven't quite earned your stripes. But he had a big belief in what he was doing and being able to change the industry. And I guess the the core belief or the observation he had that the insurance broking model was a little bit broken and it wasn't keeping up with the businesses that it was actually servicing. So, as companies got more complex, more global, more technology driven, insurance broking was still being delivered in a very transactional way that wasn't delivering to the customers what they wanted. So that idea has evolved into a kind of strategy now, and that's our sort of go-to-market and the way that we actually approach insurance broking. So, we tried to really, turn insurance broking from being, a cost center to something that's more of a source of advantage. So sort of plays out in a couple of ways. It's a better understanding of risk. It's more structured decision making and probably stronger placement and claims. That goes into everything we do. Like our values in our business, one of them is leave no stone unturned. So for us, when you're talking about, claims advocacy or placement, everything we do is deliberate and we build our strategy around some core beliefs. That's where the vision that Wade had at the start, but then the values lean into that sort of proposition as well. So that's kind of what led to the business being founded. It's grown quite strongly. We're now national across Australia. We have quite a large base. We do with some of the biggest companies in the world. We also place policies in around about 24 countries globally. So we have quite a big multinational contingent, and we work with a number of partners globally.
Great. You're also not a typical insurance broker. From your profile, you're more of a fintech, from a fintech background, and does not necessarily have a insurance broking or insurance underwriting background. Could you tell us how you ended up at Knightcorp, and how do you find, coming in? You've been the CEO since 2022, so it's been a few years. How do you see the insurance broking market, sort of an outsider's perspective in some way?
It was an interesting journey. I actually got introduced to Wade through a couple of contacts in the fintech industry and the technology industry generally. What sort of drew me to having conversation with him was exactly what I just spoke about a moment ago, is that he wasn't viewing insurance broking through the lens of simply placement, but how do you actually rewrite the way that insurance broking is approached? And that is a very deliberate product type strategy. It's actually trying to disrupt an industry that is defied disruption. And as somebody that's come from that technology-based industry, that was very appealing to me. Being able to actually bridge the gap between expectations and delivery, and being able to use technology to intervene to make sure that was achieved, that was a really compelling thing for me to do. So I never actually woke up, decided I was going to be an insurance broker, and you certainly don't want me placing your risk. I always say I'm the most expensive intern in the office, but I've certainly learned a lot over the last 4 years, and I think there's a great opportunity to actually deliver better experiences to customers. And at the moment, clients are actually asking for change, and at some point they'll start demanding it. And I think, taking, the foresight of Wade in taking somebody from outside the industry to help disrupt the industry itself, that is somebody that's actually thinking beyond today, trying to build for tomorrow. And that was compelling in terms of why I joined Knightcorp, but it also goes to the values of adding value to customers. And that's something that's really at the core to me. And it's one of the things that got me on board and has kept me there for the last 4 years.
Interesting. You mentioned that clients' expectations are changing. What are the expectations of the clients now? And how can brokers better serve their changing interests, changing demands?
Certainly, expectations are increasing at a faster rate, and the industry is evolving. But there's no doubt there's value in insurance broking. I think NIGA just released a recent survey, and it's saying that over 90% of respondents saw value in brokers doing risk management, their claims advocacy, and their general approach to driving better outcomes. So value's there, and that's not the problem that clients have. What clients typically have a problem with is the process. And that expectation is clear changing. They want clarity, they want speed, they want insights. So as an industry, and what we feel that needs to happen is we need to move from being reactive to being more proactive, from product placement to more strategic risk-based thinking, and from sort of annual engagement to more ongoing engagement. That's a basic expectation the clients are starting to have. And it's going to be the people that build the systems from the ground up that enable that for me are going to be able to compete into the future. And at the same time, clients' risks are getting more complex, right? So you got cyber, you got supply chain, you got regulatory pressures, all of those things are coming in. So their gap isn't whether brokers can add value. It's whether they can deliver in a way that is meaningful to customers that meets their expectations. And I think there's a big opportunity to change the way that the system is built and delivered. And that's been the focus. And we're hoping to meet clients where they're at and deliver on their expectations.
Insurance as an industry gets a lot of flack for being very legacy and not very tech savvy. And it seems to be changing. There's a lot of new startups talking about being tech first and AI native and all of that. You obviously come from fintech sort of technology background. One, how do you see the industry? Are you seeing a tech transformation, faster and better adoption of technology on one hand, and how does that sort of help Knightcorp as a company sort of change its outlook on technology and how you sort of operate? Have you been able to sort of bring in any changes?
Look, I mean, is the industry changing? The simple answer is yes. Is it changing quickly? The answer is probably no. There's a lot of rhetoric. When I came in, and I came from the fintech sector, and insurtech is a subset of fintech. So I had a general awareness of insurtech, and it just didn't get the same level of traction that fintech did. If you take banks as a good example, nobody ever thought that you could create a consumer-like experience for corporate or commercial banking. But the reality is there's fintechs these days that deliver that. But if you talk to a lot of people in insurance broking, they would say corporate and enterprise broking could never be intermediated with technology. To me, I think if that is the mindset, that will always be the case. But I don't actually believe it's true. I think it's a will. And there's now the accelerated skills out there to actually enable it to happen. So there's an opportunity there to fill that void and deliver on client expectations. And going back to why I got on board, that was one of the real motivators, not only to change a company, but to change an industry. And there's very few times that you get to do that in your life. And when I saw that opportunity, that was one of the things that sort of brought me to it. In terms of meaningful things that Knightcorp are doing to do that, I mean, going back to what I said before, it's the operating model is one of the key things that we're looking at. The traditional model is very people-heavy process. We're trying to redesign that model from the ground up, have people spend less time on administration and more time on client engagement. We've done some research and some time and motion studies, and around about 70% of broker time is spent on administration. So that means only 30% of their time is spent on either strategy work or client engagement. The ability to actually flip that on its head and actually have 70% of the time spent on strategy and client engagement, which is true risk management, and have 30% of the time spent on admin, that is the opportunity that is out there that is there for the taking. And, that's the thing that we're looking to change in the way that we operate. Probably the second pillar to that is technology, therefore, is going to play a big role. And, you asked about how I see that intersecting in what we're doing is, yes, we are going to invest in connecting data, automating processes, making sure that we're delivering on the expectations of customers so we can deliver insights. So that's faster decision making as a consequence. It's better risk visibility. It's more consistent outcomes. But it's probably worth noting that technology, whilst it might be, probably a better way of saying this, technology is not necessarily a differentiator. It's what you do with it that's going to matter. So anybody can have technology in their business. It's how they deploy that technology. You could argue, well, all you're doing is digitalizing what already exists. So isn't that just digitalization? And if all you're doing is making an existing process digital, yes, that's correct. But if you're transforming it from the ground up and changing that process, that's transformation. And that's where we're leaning into technology and trying to make a change. The other bit that we're trying to do differently is around talent. The industry is well known for the default growth mode of acquiring talent. So you acquire talent and, therefore they bring portfolio, the portfolio leads to growth. And it's a proven model. It's a strategy that works, and I'm not going to knock that strategy. What I would say is it's not a differentiated strategy. It's easy replicable. And when they've been with you for a certain period of time, you leave yourself exposed that they can go take that portfolio to somebody else. You only have to look at, Lockton's in Australia and Adviso, competing on talent, or, Howden's and Brown in the US. And you see the implications and the impacts of that. And that's because a lot of what happens in the insurance broking industry isn't very differentiated. It's based on relationships, which is great. We want brokers to be brokers and we want them to have great relationships. But if that is all there is, then the client is not attaching to the business, they're attaching to the broker. And for me, the broking firms into the future that are going to win are adding more value than just a relationship and a placement. They're actually, delivering an experience which is truly differentiated, which the client will not want to leave behind. So to me, that's the next phase of what's going to happen in the insurance broking industry and where technology will play a big role. For my mind, think about it as, the next phase is going to be not who you hire, but how you operate. And that's going to be the big difference moving forward, in my view, in terms of the industry.
Right. I mean, it's beyond relationships and trying to sort of differentiate your service and what you bring to the table. Well, I mean, Australia is a very sophisticated insurance market, highly brokered and very competitive, right? Very, very consolidated sort of on the capacity and underwriting side, but it's quite a lot of brokers, very competitive. How do you see the opportunities in Australia for a broking business, for an independent broking business? I mean, as we speak, we just heard about the big bid for Steadfast from one of the big US brokers. So how do you see the opportunities for an independent sort of a broker to grow and expand in Australia?
Australia is a very sophisticated market, but it's also a very fragmented market. As you said, it's very acquisitive. There's lots of consolidation. With consolidation comes concentration, and with concentration becomes therefore you get less differentiation, and you actually get people saying, well, I don't actually want to be with one of few. I actually want to do things a little bit differently. And who out there is doing something different? And that's where we see the opportunity. I mean, you're right. It's a highly broked market. About 50% of the market is intermediated. So there's strong demand. There's no doubt about that. But with strong demand, if you've got this ubiquitous product that is not, seen as differentiated, people will naturally look for something different. And that's where we see opportunity. And that's particularly in that mid-market space, and that, they typically are sort of highly complex businesses. They're possibly technology driven, so that leads to geographical expansion. So they've got somebody that needs that ability to reach beyond the borders that they're in. And they have sensitivity to cost and time. So, being able to actually truly advocate on their behalf and act in their interest, not in the interest of a behemoth, being an independent enables that. Right? So we can proudly badge ourselves as being independent and go to market knowing that. And whilst you could argue that's a disadvantage because we're not part of a bigger group, you could also wear it as a badge of honor and compete on that basis. Because particularly a lot of the businesses we deal with, I mean, our tagline is forerunners in the unforeseeable. And the reason for that is we see ourselves as a forerunner. And the businesses that we tend to deal with are forerunners as well. So they're looking to challenge the status quo, do things differently in their industry. that means that they tend not to want to be with the big guy. They want to be with the number two that's challenging what's happening in the market and looking for better and different ways to approach things. The other thing, I guess, where we see opportunity in the market is complex risks. So, with those businesses challenging things, let's take AI as a good example. A lot of policies are silent on AI. So we do a lot in the technology sector, and getting wording written in that is positive wording around AI and AI usage is a big part of what we do. So things like climate, cyber, supply chain, they're all complex risks that are up and coming in the market. And we're very well placed to actually negotiate that. We don't have any sort of portfolio deals that we've got with people. We're truly independent, and what we're doing is going to the whole market to get the best deal for the customer, because at the end of the day, it's about advocacy. And broking by nature is advocacy. Doesn't matter if it's about the placement or it's about a claim. Both of them are advocacy elements. And we take that really seriously. And people actually notice that. And, when you get into complex risks and you're looking in taking every angle to a problem, that's where we tend to win. And because we're big enough to be meaningful and small enough to be agile, people actually notice the difference. They still get a really good outcome, but they see the way that we operate and we act and behave, and it's truly differentiated. And that probably goes to my final point in terms of where I see opportunity in the market. And I've touched on this a couple of times, but it's experience, right? I said it before, most brokers optimize for placement, and that is all their processes are wrapped around that. But a differentiated experience is actually what the customer wants. So it's not about what you place, it's about how you can, I guess, intelligently and efficiently place that policy. And that's where we see the opportunity in the market is to lean into that.
So you're saying there is space for a challenger broker, even in a very concentrated market like Australia?
There has to be. Because there's always going to be people that don't want to be with the big guys. I mean, give you an example. A lot of our clients are VC backed, and the thought. Whereas there's a saying that a lot of the brokers will say to me is that no one ever got sacked by having Marsh on their board paper, and it's true, right? And I don't blame them for that. And the ASX 200, I understand why they want that. But there's a lot of other companies who say, you know what, I want somebody who can meet us where we are. I'm a dynamic business that's agile and facing challenges day in, day out. And I want somebody that can actually match me on that and can help me face those challenges. Because inherently, that's what insurance broking is about, is helping businesses be successful by actually allowing them to mitigate risk. A lot of people forget that insurance has become the product, but it was never meant to be. The product was actually risk management. The insurance was the backup. But insurance has just become the product. And that's why I say that a lot of brokerages actually optimize for placement. So taking that really different approach, that's sort of music to the ears of a lot of the dynamic businesses that we deal with that are looking to grow and scale.
Looking ahead, what's the sort of medium-term plans for Knightcorp? And, in 3 years, what would success look like for Knightcorp?
For me, success is not sort of a destination, it's proof, right? And you think about it in terms of what would I want to see for us to be truly differentiated. We'd have a different operating model. We'd have brokers that can be more valuable with better systems, and we'd have clients that are materially better off as a consequence. So, you have, I guess, more scalable advisory model, you'd have faster client outcomes, and you'd be evolving talent at a rapid rate to deliver on that. So ultimately in 3 years, if I think about it, if I think about success, if majority of the brokers are spending the majority of their time on advice and the clients are genuinely feeling a difference, we've done what we're set out to do. That to me will be success.
And does Knightcorp have any acquisitions or growth in M&A plans in the horizon?
It's interesting that you asked that question because as I sort of inferred before, there's a lot of activity in the M&A space, consolidation in the market. And of course, do we get approached and do we get offers? Yes. I can categorically say there is no plans to be acquired. So we're not looking to do that. At this stage, we're also not acquisitive. So we're not actually looking to acquire other businesses. We truly believe that consolidation will lead to fallout because you'll have dissatisfied clients. Somebody that's providing an experience that is going to meet the needs of these clients is an opportunity, isn't in and of itself. So for us, we see the actions of others could be, a growth strategy in itself for us. Now, we're not holistically relying on that as our growth strategy, but we certainly see that disruption not only disrupts the industry, but it disrupts clients. And when clients become destabilized, they actually look for options. And we see the potential of us filling that void that is maybe there, that because the consolidations occurred, those true independent brokers that are of a size and scale that can truly deliver for clients, there's going to be less and less of them. And that's where we see real potential.
Trent, that's all the questions I have for you today. Fantastic conversation. Very nice talking to you. Thank you very much.
No, thanks for your time. Really appreciate it.
That's all from us in this episode of Between the Lines. We'll be back again in 2 weeks. In the meantime, you can connect with us on LinkedIn. Make sure you're subscribed to our daily and weekly newsletters delivered straight to your inbox. And of course, we'd love to hear your feedback on the podcast. Email us at editorial@insuranceasianews.com. I'm Mithun Varkey. Thanks for listening.